Hey, folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This intraday analysis video is for Monday, November 22nd, 2010. Well, the markets are selling off today, folks. We're going to discuss the reasons behind it. It's very clear cut. Bottom line is you have issues in Europe. Issues in Europe and bailouts in Europe mean a weaker euro. A weaker euro means a stronger dollar. A stronger dollar has an inverse relationship to the U.S. markets, and again, we are seeing the markets move to the downside on the back of that. You can see again, we opened lower, had one surge up to gap fill. Beautiful shorting opportunity was discussed in the intraday stock chat. The market then has tumbled down here, pausing with a bear flag formation, and again, that's a beautiful bear flag telling you it's going to fall further, and then sure enough, it does fall further, and now you're getting a little bit of a bottoming tail there, right here, long tail, two tail theory, not a full three tail theory like we'd like to see, but nonetheless, markets are trying to struggle back up here, but nonetheless, volume remains extremely light. On the back of that light volume, it's all about the dollar. Take a look. UUP, basically a vertical move all the way to the upside. And again, we're now trading at a double top going back 2 days to last Thursday's high pivot. And again, notice the angle of the trading day, folks. That's what it all comes down to. Here's where the dollar went today. Like that. Where have the markets gone? SPY. Let's pull up that chart. Just like this. So you see how it's perfectly opposite to the dollar. And again, always remember, inverse relationship with the dollar to the markets, and you will be a much better investor and trader in understanding that. All right, now again, a couple interesting facets today. The Ireland bailout again is underway. They're going to be bailing out Ireland. Now, initially last night, this is something very interesting. Last night, the market or the futures on the S&P 500, Dow futures, Nasdaq futures were higher overnight session. And again, if you go to your overnight futures chart, for those of you that have it, you can see that we were up as much as 8 points or so on the futures. However, all of a sudden, they turn negative. Why do they turn negative? Well, initially, the bailout seemed like a good thing. Okay, so you're not going to have a major catastrophe in Europe. But the bottom line is this. If Europe's going to bail out Ireland, they're going to have to bail out all the other countries as well. You bailed out Greece already. Now it's Ireland. Next is going to be Spain and Portugal, then Italy, and then who's next? And you just can't bail out some and not bail out others. And again, that's why the futures again turn to the negative side. Initially, it was just thought, okay, Ireland, this is one less thing we have to worry about. But then people started to realize, well, if you bail out one, you bail out all. So in that facet, that dropped the euro and that strengthened the dollar. And we all know that based off of that, you can see a clear-cut drop in the markets today. Dow right now is hovering down 125 points. Nasdaq's down 13. S&P 500 is down 13. It's interesting today to see this, folks. The S&P and the Dow are down over 1%. In fact, 1.1%. Nasdaq is only down 12.5 points, or 0.5%. Nasdaq is much, much stronger. You can see certain pockets like Apple Computer here. It was up much more, has come in, but nonetheless, Apple's still up $1.17. And even on Amazon, take a look at Amazon. It was up much, much more this morning on POMO activity, and that's the speculation on my part. But you can see it's come back in, still up $2.37 on Amazon.com. Now, again, Amazon retailers overall are still doing well. Take a look at COH. This is a very interesting chart. Coach, again, taking a look at the daily chart. Look at that Coach chart. The retailers continue to do well because of what the Federal Reserve has done, folks. And that's the thought process behind this is very intricate. What you're basically seeing the Federal Reserve do, and I've talked about this in previous videos, and for those of you that are in the Research Center, you know in depth what I'm talking about here. But we've seen the Federal Reserve pump tons and tons, as in trillions of dollars, into the markets. Now, pumping trillions of dollars into the markets has created an artificial kind of asset bubble where assets are now rising. You've seen food and energy go up and a lot of these other things. The markets have responded. As the dollar drops, the markets must respond in a positive nature to keep their real value. If the dollar drops 10%, markets technically should go up 10% in response. But even though the average person's not gaining real buying power because the dollar's worth less, they still see their 401k going up 5, 10, 15, 20% as the dollar drops. Okay, now even though they don't realize it's real money hasn't changed. Their real buying power hasn't changed. They feel richer. When they feel richer, they're going to go out and spend more into the holiday season. You have Black Friday this coming weekend, and that's really been the game of the Fed, is to make people believe there's a real recovery by inflating the asset prices, and therefore they will go out and spend, creating a real recovery. So it's almost like fooling the public into this. Now, again, if it works, it works. I don't think it ultimately will work. I think in the short run it may work, but not in the long run. And I think it's a very, very sketchy and scary thing to be doing right now. But again, that's the game of the Fed right now, so be prepared. In any case, you have charts like Coach. Here's Coach. Take a look at your weekly Coach chart. If I zoom out on this, you are now above 2007 highs on Coach. All right, now this is a retailer, high-end retailer, but my point is again, this is in 2007 when this was at the highs. This is when the market was doing as good as it could. We had a huge bubble in real estate. Everyone was just turning over houses and making hundreds of thousands, if not millions of dollars, turning and flipping houses. And Coach was at this level, actually a little bit below. Now you have a recovery that, again, we're talking about 3% growth in the economy if we're lucky on the GDP side, and you have Coach back to these levels. And again, this is all on anticipation of spending in the holiday season. I think it's a little overdone, to be honest, to the upside, but no normal person would be looking to short going into Wednesday and Friday of next week. I think you got to wait till afterwards and then reevaluate based on where the market is, where the cycle dates are. Again, we nailed the last cycle date perfectly for the pullback. Ever since that cycle date hit, the markets have not been able to get much of an upside and in fact have moved lower pretty nicely as we've seen over the last 2 weeks. So again, we have to look for the next cycle date. When's that going to come? We have to be looking for all these other factors, and this is all information that will be revealed in the research center. You have to go join that research center, folks. It includes everything underneath the research center is included for $49.99 per month. And again, we release education, swing trades, market analysis on everything from commodities to currencies to individual stocks. All that stuff is inclusive in there. All right. Now, a couple other things. Coach, we just talked about. How about Tiffany's? Take a look at that. Same thing. High-end retailer, obviously. And look at that. It's above those highs from 2007. That's actually quite impressive. Now, you have some other ones that aren't, but even some are. I mean, JCPenney's had an amazing move. And you can see if I go back to the daily chart, look at the move up. In fact, we had a nice little short up in this range, and you can see it's come back off of that dramatically. But look at this move up that it's had. So the retailers expect big things for the holiday season. Is the public essentially going to deliver with tons and tons and billions, if not trillions, of spending? Again, we'll probably find out towards Monday of next week, Tuesday of next week, how the sales from Black Friday were. We'll get a sense about it. I think it's going to be good. I just don't know if it's going to be up to par. One of my favorite little stocks here to keep an eye on, BGP, Borders Group, low end of the chart retailer here. Pretty cheap in my opinion. 3+ million shorts. Could be a squeeze candidate at some point, so keep an eye on that. Again, that is some stock that I am watching very, very closely myself and do like quite a bit. All right. Other than that, let's go back to the SPY. We'll just take a quick look on the SPY. That's the daily chart. We're not going to cover that since that's covered in the nightly video for the Research Center members. Again, every night, 30 to 40-minute videos for the Research Center members on new material. But you can see, again, the dramatic drop. A little bit of sideways movement here. Slight little bounce. Markets are trying to gain footing. Volume is extremely light. We've only done 107 million on the SPY. All week should be light on the side of volume, although if you get some sort of major development in Europe, it could cause a spike. Other than that, look for that light volume issue. Again, join the Research Center. Join the chat room. Next methodology webinar is coming up. It's the last webinar of the 2010 year, which is December, coming in early December. You can find it under Education Seminars and Webinars. And again, if you sign up for this webinar, you get a free week in the intraday stock chat included. So again, join now. Whether you're a member now or not, you'll still get a free week. It's going to be a good experience. We'll be doing plenty of trades, plenty of analysis, and you want to take advantage of that ASAP. We'll talk to you soon, folks. Take care.